Hello and welcome to this new episode where I will talk about zombie companies. But not just any zombie companies, I will specifically discuss companies that have been zombified by venture capital funds. Venture capital funds, also known as venture capitalists or VCs, play a significant role in the startup ecosystem. They provide funding during the early stages of a company's development. Previously, startups had to struggle to secure funding, but nowadays, there is so much fresh capital available that it has reversed the dynamics. VCs are now competing to find promising startups to invest in. However, this situation can be dangerous because VCs may end up financing increasingly non-viable projects. In the past, many startups followed the bootstrapping model, which involved using personal funds from family and friends, and minimizing costs to create a profitable company. The goal was to become self-sustaining before seeking external capital to scale up. But things have changed. Now, startups receive funding based solely on an idea, even before selling a single product. This approach has its advantages in a fast-paced world where being the first on the market is crucial. But it also creates a problem. In the past, startups knew relatively quickly if their business was viable or not because they had to rely on their own funds. They could only sustain themselves for a few months or a couple of years, which forced them to assess profitability early on. However, with the influx of fresh capital from VCs, this critical moment of determining viability keeps getting pushed further into the future. Founders, as long as they can find fresh funding, tend to continue, even if they suspect their business is not as promising as initially thought. The never-ending cycle of funding, especially from early-stage VC funds, can keep a company alive. Furthermore, an early-stage VC fund specializing in startups can sell the company, or rather the adolescent startup, to a growth equity fund, which can then take the company public even before it becomes profitable. Some might argue that extending the startup phase can create companies that require significant investment and go further. However, it all comes down to finding the right balance. A startup taking 3 to 4 years to become profitable is not necessarily a problem, but constantly extending the timeline and postponing profitability indefinitely is a cause for concern. An example often cited is Uber, which was founded in 2009 but only went public in 2019. It has reported losses almost every quarter since its inception, with a brief period of profitability in 2018. The losses in 2022 amounted to $9 billion, with a projected small profit for 2023. Is Uber a zombie company? It's hard to say definitively, but it is concerning that it took 14 years for the company to reach potential profitability. Each pitch to investors likely projected profitability in the near future, but the deadlines kept being pushed. Another example is Asana, a company that helps organize work within businesses. Although it is no longer a startup and is publicly traded with a market capitalization of $5 billion, it provides a good example of startup financing. Looking at its financial statements, despite boasting a 90% gross margin, it spends almost its entire revenue on marketing and operational costs, resulting in a net loss. It's worth noting that these examples are not meant to be a comprehensive analysis of these companies' financial situations, but rather illustrations of potential issues. As an investor, it is essential to consider all aspects and examine a company's financial statements thoroughly, not just rely on the presentations and pitches that often emphasize growth and promising metrics. In conclusion, the abundance of fresh capital from VCs has changed the startup landscape. While there are advantages to quick access to funding, it also prolongs the period before determining a company's viability.